Just a reminder, everyone, disclaimer here. So any materials presented today are purely for educational and entertainment purposes. Absolutely do not act on any of this without consulting a financial advisor, looking into the legal and tax advice that you need related to any of these trades. This is merely an illustration. I want to show you how things work from a professional standpoint. And so absolutely be careful out there and just know that this is for educational purposes only. Okay, welcome everyone to the show. The day has come. NVIDIA earnings are out after the close, and I can't remember the market anticipating something quite like this. And I think we said that last time they reported. So this is really something because I think people feel like, they've really shown unbelievable growth and profit margins so far. The market really wants to see a follow through of that. Any kind of, and given the fact that we've seen a little bit of weakness in the AI area lately and in tech in general, there is some worry that maybe some caution has been seeping into the sector. We see that hedge funds have really de-risked in the area of tech. That also means that if NVIDIA really beats, we might see a re-risking, meaning a lot of funds have to kind of up their allocation to NVIDIA and other stocks of that nature in the AI and the tech area. That may happen as well. Lately, we've seen them move out of that area, the things that were working really well the first 6 months of the year and much of last year, and moving that money into the broader market. So we'll see how this works out, but really there is quite a bit riding. I think not as much for the broader market. I think the broader market is really taking its cue from something very different at this point. Tech and AI was kind of the place to be for a long time with rates really high. Now Powell has kind of said that, listen, we are going to defend employment. The unemployment numbers aren't really that significant. It's a matter of supply, which I've been saying in my shows and shorts for weeks now. I've been saying that the unemployment number is pretty much garbage and not to worry about. And he sort of said, listen, inflation's been vanquished. At this point, it's about rate cuts and we're ready to do it. So the broader market is really taking its cue from that. I don't think the broader market cares very much about NVIDIA and AI. It is now marching to the beat of its own drum. So interesting cross currents happening here. We'll have to see how that plays out tonight. But I wanted to drop a video on how a pro will approach this. I was a professional options market maker for about 12 years. And over the last 3 decades, I've managed about $1 billion in option strategies. So very aware of how things work from a professional standpoint, from a market maker standpoint. I wanted to show you a little bit about how things work. Now you'll notice if you're watching this kind of thing that the one-day straddle on the SPY is trading quite a bit higher than the one-day SPX straddle. Now why would that be? We can see that in the chart here. One-day straddle costing about 35 basis points more than the equivalent SPX straddle. And if we read the text here, the cost of that straddle is higher than the SPX straddle. Reason is the right to physically exercise your contract, right? You can do this after the earnings release. So if NVIDIA comes out with a big number or a poor number and there's a big move in NVIDIA, which is now a very large percentage, whatever it is, 7% of the S&P, it is going to be market moving. So the SPX options are going to cash settle on the close. They are not going to take the NVIDIA's move into account. The end of the day is it for them. The SPY, however, you can trade after hours. You can exercise calls or puts up to, depending on your platform, don't quote me on this, you'll have to check with your particular platform, maybe 5:15, 5:30, maybe even later, but I would feel more comfortable saying it's around 5:15 to 5:30. So that takes into account the number that NVIDIA puts out and part of the call as well. And as we know, sometimes numbers can come out, the market takes it a certain way, then the call starts and somebody says something negative and things go the other way. So you could get a lot of movement. What can you do if you are long calls or long puts? Well, let's take a look here. First of all, I want to show you guys something. This is going to get a little deep into the weeds. These are things we teach in our programs, very important to know. Long calls, if you're a long calls on NVIDIA and you short stock, so long calls plus short stock equals long synthetic puts. This is an important put call parity part of the glue that keeps option markets together. The calls are related to the puts, are related to the underlying, and those things trade very, very closely and keep each other honest. Unless there's a hard to borrow situation like a GME soaring, weird things happening like that when you can't borrow a stock, that's going to change the math significantly in the options chain. But on most stocks, this is going to hold very, very well. Long calls plus short stock is going to equal long synthetic puts. Second, long puts plus long stock equals long synthetic calls. So what this means is, as a market maker or a professional or anybody really, you can turn a long call into a long call position into a long put position just by virtue of selling stock against those long calls. So as a market maker, people would often ask me, why do you want to buy long calls at the top after a huge run in a stock? I said, I love to do that. That's one of my favorite things to do because the volatility is compressed on a big run in a stock. And I get to buy calls at the top, sell stock against them, and turn a significant portion of them or part of them into long synthetic puts, cheap puts, because the volatility has compressed. So one of my favorite things to do as a market maker was buy calls at the top. Retail might not understand that because they think, well, why are you, I'm going to saddle you with a whole bunch of calls right after a big run in the stock. I don't mind. I'm going to sell stock, now synthetic puts, which I can trade way down. So I can always turn my position from one thing into another by trading other options, but also by easily just trading the stock. And I can do that with puts as well. If somebody sells me a whole whack of puts after a big sell-off, what can I do? Well, I can buy stock against those puts and turn that position into long synthetic calls. I can turn those puts into calls, which is a really, really cool thing to be able to do. So you need certain kinds of accounts and you benefit from margin, and you benefit from, sometimes market makers benefit from very low costs in order to do things like this. And that's something to keep in mind. But this is something that retail can do as well. So let's take a look at NVIDIA. So let's say it's coming off a little bit here this morning, down $3. They're a little bit nervous on this number. I think some plays are looking interesting, like a 140, 150 spread. I would go out to, if you're playing along here, I would personally give yourself another 7 days. The vol is so high. Look at the vol here. 106 next week and 184 this week. Now, volatility doesn't have as much meaning when you have 2 days left. But in the case of something like this, it's meaningful. And so you can see that if you do the math, you can buy a 140, 150 call spread expiring next week for not much more than a 140, 150 call spread expiring tomorrow night. And that's a big deal, right? Because NVIDIA has this tendency to gap and go. It will make a big move, but then there will be follow through a lot of the time. Some people call that drift. So you get that move and then you get everybody just kind of continuing to pile into the stock. And we saw that last time. The gap, and then the stock just keeps drifting up and up and up and up and up into what is a strong number. So giving yourself that extra bit of time may be a way to do this. And you're not going to pay a whole more because of this big volatility differential that we're seeing. But that's not the point of this call today. Let's say you are trading tonight's earnings, right? This is what you want to play. You want to be a part of this situation here tonight. It's exciting. And you think NVIDIA is going to outperform. So let's say you're going to buy the August 30 140 call. So those are the calls that expire August 30. So you've got a couple days on these. You're going to buy 10 of these for $2. You're going to spend $2,000 on it. Let's make it simple. No, let's keep it at 10. And let's take a look at how this looks. This is your standard call, long call strategy here, right? You're going to risk $2,000. You're paying a little bit over $2 for these, so you're going to spend $20.30 on this trade. Let's lock it up here. So right now you're going to spend $20.60 on this trade, and you're going to make money. Your break even is going to be $142. Not bad, right? Even though the vol is absolutely juiced, but as I said, implied vol doesn't have as much meaning with a few days left. it's probably gone from 140 to 170 overnight because the stock options haven't really moved. The prices of the options haven't moved. So not very meaningful in terms of that specific number. You have to just look at today's or tomorrow's potential as a binary kind of event. So is NVIDIA going to move up to 150? I think they're pricing a little bit over 10%. That's going to take us up about, what is that, $12? That could be a little bit low. I don't know. It could be a bit low. But let's say you're going to bet that this is a huge beat and all these hedge funds are going to have to start reallocating, and you're loving this. So you're going to buy these at $2, and the stock, let's say it opens at 150 tomorrow. So what happens? At 150, you've paid $2 for these 140 calls. It opens at 150, you're up $8, right? But what if it trades there tonight? What if the number comes out at 415 or 420 or whatever it is? I think it's typically 420. And you get a gap up to 150. Do you have to wait? Well, what some people are going to do is they're going to sell their stock and exercise these calls. So they're going to exercise these calls. They're going to buy stock at 140, 1,000 shares at 140, and they're going to sell in the aftermarket at 150. You've made $8 and you no longer have a position. That position gets cleaned up by the morning because you have no position anymore. You've exercised your calls. You've shorted stock against those, meaning you're selling the stock that you're buying with the calls, and that's it. Case closed. What can you do as well? That's not what a market maker would do. That is a mistake if you have the power to do what I'm going to show you. What if you sell stock against this position? So what I'm going to do is, let's say I sell stock at 150. Okay, I'm going to sell stock at 150. Sorry, this is going to take a little bit. We're not super polished today, and we're going to sell a full allocation against our long calls. I'll show you in a moment that you can do less than that. But what happens? Well, what happens? Look what this changes into. Now you're long a put at the 140 strike. Remember our synthetic. If I'm long calls and I short stock against my long calls, I create long synthetic puts. So what's happened here? Without the long stock, this looks like a long call. Pretty easy to understand. What if I long turns it into a long put? Without the stock, long call, I have upside. Add the short stock, 1,000 shares, I create downside. So what have I done? I've locked in my $8 gain. I bought these at $2. I've sold stock at 150. I have locked in a gain. I cannot lose on this position if I'm authorized to do this kind of trade in my account. I have sold my full allocation of stock against my 140 calls, and I have locked in an $8 gain because I can exercise these now at 140, which I will do, which I may have to do manually. Keep that in mind. There will not necessarily be an automatic exercise. So absolutely critical that you make sure that if you do this strategy, or even if you just own these outright, you have to manually exercise these. So you better look into that today, figure out, well, how do I do that? How do I let Schwab know how to do this? How much time do you need in order to do this? Take into account that it might be very, very busy. Hopefully you can get through. Hopefully you can get this done. Sometimes it's just something you click. I know on Interactive Brokers, it's something you just do. You click, exercise calls. Do you have to call someone? Can you do this via the platform? These are things you need to look into today before executing something like this. Whether you sell this stock or not, you need to know that, because if the stock closes at 125, these are not going to auto exercise, as far as I know, in most platforms. So what have I done here? I've sold 1,000 shares against my 140s. I paid $2, which means my cost is 142. I've sold my stock at 150. I've locked in almost $8. Boom. But instead of just exercising these and selling my stock, locking in my $8, I can now lock in $8, but also do something fantastic, which is create my synthetic put. Now what happens if the stock drops to 138? Let me show you what happens here. So let's say we go to 138 what happens? My calls go to zero, right? Technically, they're worth nothing. But I'm now able to buy back stock under 140. I have a synthetic put at the 140 level that is free. Not just free, I have an $8 credit on them. I actually own puts for an $8 credit now. You can almost think of it that way. So if the stock drops to 138, I can buy back 500 shares, let's say. Let's say Jensen starts talking at 5 o'clock and he says something that the market doesn't like and we drop to 138, I can buy back 500 shares. Boom. Risk-free, I can buy back 500 of my short 1,000 shares. Now what do I have? Now I have a straddle because I'm long 10 calls and I'm short 500 shares. That means I'm long net, outright long 5 calls, but I'm also long 5 synthetic puts. So I've kept an extra 5 puts. Now what if the stock goes to 125 at that point? I can buy back the entire balance of 500 shares at 125, and now I'm just long this call, which has served its purpose. I don't need it anymore. So what happens here? So I buy back my 500 shares. So let's do the math on this. I bought calls for $2. Let's just make them $2, not 206. I sold stock at 150. Boom. I've locked in my $8. 8. The stock goes to 138. Buy back 500 shares because I think will go a bit lower. It's turned around, it's getting ugly, it's going to go lower. I don't even have to buy back any stock, but let's say I buy back 500. So I've made 500 times $12, right? I sold at 150, I bought back at 138, and I'm still 500 risk-free. If the stock goes back to 150, I can again sell the 500 that I bought back at 138 because right now I'm long 5 calls and I'm long 5 synthetic calls. So now I can sell that 500 back and I'm short 1,000 shares again, and I can exercise my calls. So I've had a nice pass back and forth. I've sold my stock at 150. I bought it back at 138, 500 of it. Stock goes back to 150. I sell my 500 shares again, and I've done way better than if I just exercised these calls after the close and sold my stock at 150. Right? I've made an extra whack of money by having made this $12 on 500 shares. Now, what if the stock keeps going down and it doesn't go back to 150? At 125, I buy the other 500. So what's happened here? I've lost $2 on the calls. Fine. Good riddance. They've done their job. But I made $12 on 500 shares, and I made, what is that, $25 on another 500 shares. So I've made 12.5 on the second 500, and I made 6,000 on the first 500 that I made $12 on. I've made 18,500 instead of just exercising those calls in the after hours and making $8,000. That's a big difference. Now, what if I didn't buy that initial 500 back? What if I just sold at 150? Jensen starts talking. He says something negative. The stock goes to $25. Now I've made $1,000 shares times $25. I've made $25,000 because I own those 140 synthetic puts now. So I'm going to make an extra $15 on those below 140. So I'm going to make $25,000. I'm going to lose 2,000 calls. So round trip, I've made $23,000 instead of only 8,000. Now, keep in mind, if this stock goes to 150, you sell your stock and it goes down to 125, you are not exercising these 140 calls anymore, right? You are not putting in your manual exercise, Schwab or whoever, to say, I'm going to buy these, I'm going to buy stock at 140. It's now 125. You do not need to exercise those calls. You've sold your stock at 150. You've bought your stock back at 125. Case closed. Job done. Now, what's the downside to this? Well, if I do this and I sell my stock at 150, I sell my 1,000 shares at 150, I'm foregoing the upside beyond 150. So if I exercise these, and if it's 515, 510, and this stock is at 150 still, and I've sold, and I'm long these 140 calls, you're going to exercise them, and you're going to come in tomorrow morning, either long 1,000 shares, or you're going to sell them in the aftermarket. But if you're going to hold on, exercise those calls and hold on, well, the stock could go to 160. So you're going to make an extra $10 by holding it overnight. But the whole idea is that many people will come in, and after the market closes, they will exercise those calls, the 140 calls, and sell stock in the aftermarket so that they can lock that in. And that is a mistake. Yes, you're going to make your $8, but you're going to give up an incredible thing, which is your synthetic puts that you've created by selling stock against your long calls and waiting and seeing what happens. And if the call goes poorly and this thing travels through 140, you get to make $1,000 for every dollar it drops below 140. Okay, so I hope you guys understand this. Now, this all works with puts. So let's say we're negative on NVIDIA, the earnings come out, and we're long the 125 put. We've spent $785 on them, and the stock goes to 110. Well, right now, this is what our position looks like, a long put, right? This makes sense. We have $785 on the line. We're going to risk $7,000, $7,900, because we spent $790 on those. What happens if I buy this time? Remember, long puts and long stock equals long synthetic calls. So if I buy 1,000 shares against this position, what have I done here? Boom, I've turned it into a long call. Look, I'm going to remove the stock, long put, add 1,000 shares of stock, long call. I've got a long synthetic put. So I spent $790 on these puts. I buy stock at 110. Let's say it goes to 110. I've locked in $7, right? Because cost price on these is about 117. At 110, I've locked in $7. But now I have a synthetic call at the 125 level. What if on the call Jensen comes out and says, "Man, things have never looked better, and we think the party's going to keep going for another year." And this stock bounces to 140. Now you've got 1,000 shares to sell at 140, 138, 137. You've got a free shot on the side, as opposed to somebody who takes this put, exercises it in the aftermarket, and buys stock to close out that short position. Okay, so this is a way that market makers think about things. This is called delta gamma trading. You're going to trade against these positions. And it's something that you can also do on longer term positions, but you need to be more aware of. So if I'm long, this is getting a little bit deeper, but if I'm long 140 calls and the stock goes to 150, there's still going to be probably quite a bit of, now the vol's going to drop. So we have something called VANA. As the implied volatility drops, your delta is going to be getting affected on that. So you're not going to be able to sell the same amount of stock, because what you're going to be doing against that position is you're going to be selling stock against this in the money call, which you're still going to lock in money on, right? You're going to lock in money if you sell the entire stock against that 140. You're going to lock in money because you've only paid $6 for the calls. So you could lock in $4 at 150. But let's say it goes to 140, let's say it goes to 130. No, let's say it goes to 134. You might just sell on a delta. If it goes to 134, you're going to be at the money and you're going to sell maybe around a 50 delta. This is getting a little bit deeper. I wanted to keep it nice and clean today, where it's, either the calls are worth 100 delta or they're worth 0. It's much easier to explain these concepts. You can take it a little further and start to trade on a delta, on a specific delta. But you need to be aware of the movement of implied volatility. When implied volatility gets crushed tomorrow, as it probably will, your deltas aren't going to be what they say they could be today. If you model this out, it might tell you your delta is going to be 30 tomorrow. But if you need to include a volatility drop to account for that. So this is the kind of stuff we teach in the program. Check out the description below. We have a number of different programs that teach some of this and that get into the entire program that involves 5 pillars of how we look at option selling, how we look at option trading. I just added a Condor chapter to the program. So always adding new value, an unbelievable amount of value that you get with these programs. You get either 6 months or lifetime in my Discord, where we talk about this kind of stuff, all kinds of amazing research, charts, all sorts of great stuff, risk gauges, because option selling without risk gauges, without risk on, risk off signals is terrible to do. You are going to be doomed in the long run if you are not looking at risk and looking for signals to pull back on the gas pedal. I'll tell you that right now. I see tons of people who make money over 2 or 3 months and then they give it all back and then double that because they have not adhered to some sort of risk management system. So we are all about risk managed option selling for income. That's what it's all about. That's how you succeed at this in the long run. So check out our programs below, and thanks for watching. Good luck today.